All right, now we have the financial document. If you can look here, you have incomes, you have assumption, income statement, balance sheet, cash flow, summary. The first thing that you do, you come to country and you put in your country. You select your country. When you select your country, you automatically put in local currency, and you come here, product. I'll advise you to limit yourself to 2 products. There's a reason why. First, you have your live chicken. Secondly, you have your chicken droppings. Now, these figures here are very important. If I were you, if you are in Cameroon, I would prefer you write down the exact same figures as they are. 13 for company tax rate, bank interest rate 11%, inflation 5%, building 5%, furniture 5%, equipment and machinery 4%, vehicles and installation 5%. Now when you look here carefully, you will notice that the growth rate, enter the expected yearly growth rate for your business below. Now you are estimating that your business is going to have a particular growth rate every year. It is advisable to have a unique or progressive but consistent growth rate. Don't start with 5% and come and put 15 here. You can start 5, 8, 12, stuff like that. But what is important is that your growth rate has to be steady. It has to be a steady growth. That's why I see 5, 10, 15, 20, 25, 30, 35, 40, 45. So make sure the intervals is smooth and realistic. Don't say after the first year. Don't say something like after the first year. The first year is always left empty. Don't put anything on the first year. Just put 0 because you are starting. There is no growth on your year 1. After the year 2, that's when you measure your growth rate. You are at year 2 to measure how far you have come from year 1. Are you understanding? So that's what you do. Now if you take a good look here, all this is, the interval is very, very coherent. That's 5, 10, 15, 20. You do the exact same thing. If you are using a smaller figure, maybe you are starting with 3%. Make sure you are moving from 3 to maybe 6, 9, something like that. You might not use 5, you might use 3, you might use 2, 4, 6, 8, 10, 12. But make sure that you can even use 7, maybe 7, 14, stuff like that. All right, now this sales growth rate is for the first product, which is chicken, and we have the second one for chicken droppings. You do the same thing. The second one you might differ from the first, but make sure that intervals is the same. If you take note here, you realize that under here is 5% consistently. That's the sales volume. Your sales volume, because you know that you are maybe repeating the same is the price, rather you are maintaining the same price over the years. So you focus, it's not like this year you're selling one chicken for 4,000. Next year you're selling, those factors are not just determined by guesswork. There are factors that determine the growth of the price. But here, it is not here that you just assume that. You just assume that, okay, your price is, you are going, just like since that you started buying big pen, is always 100 francs. It's almost the same thing, except for some external uncontrollable factors that can cause the price to change. But your assumption, you are assuming that you keep selling your chicken for 5,000 or 6,000 or 4,000 or whatever price you are selling. You're not anticipating that something will happen tomorrow. You're not like a prophet that is saying that, okay, tomorrow things will be bad and you increase the price. No. All right, I think that's practically everything concerning this aspect. Now, when you look here, direct cost is being maintained throughout. Almost everything here has been maintained throughout at 5%. Utility and everything keeps the same rate. Now go to startup cost. Startup cost, you have land, building, furniture, equipment. All of this is wrapped up into one. So if you have your equipment and machineries, you can wrap up all of them into one total cost. Vehicles, installation. Because if you want to list everything, it might not enter here. There are some people that can actually expatiate on this because this particular field is not locked. They can expatiate on it, but for you to be safe, such that you don't mess around, don't expatiate, don't add rows and columns. Just work with what you have. Opening inventory. Opening inventory is like what you are starting your account with. Here we have 242,000. This amount here is automatic, so you are not the one to put it in. All you need to do is to fill all of this realistically, and this will come out. After explaining, then I will show you now how to copy all those things. Same thing you do here. Now these are the various employees that you have, employees rather. For instance, if you are senior manager, you don't come and write 2 here because you don't have 2 senior managers, and there's no need to put a number of employees more than 1. You have just 1 manager, and throughout all the years, you see, year 1, year 2, you are going to have just 1 manager, except you get to pay maybe year 6, because all of these figures have to be explained in your business plan. If in year 6 you're having 2 managers, it means that your company has expanded, meaning that you have 2 branches and you have now 2 managers, and maybe after 10 years you have more than. So that's why you see that figure change. You know that if the figure changes, it also multiplies the salary. Now you come and fill in the salary that you will pay your manager. Remember, all these are assumptions. You have 1 manager from the 1st to the 5th year, and you are paying him 135,000. From the 6th year, you have 2 managers. That amount will double. Same thing down here. You come down to sales, customer support. You have just 1 person, and marketing. You have associates. It will be wise for you to maintain just 1 person, 1 office. Don't go and put a manager and assistant. It will not reflect well on your company because you'll be spending a lot. Now, another thing I want you to know is that you can also change this information. Instead of IT, you can put whatever you want to put there. Maybe you have drivers, or you have whatever post suits you. Whatever post you know your company is going to have, you change it and put there. Now, back office support, legal, all of that, the manager for that is this person, no assistant. The same way I've explained before. Operation support, front desk, and all the like. Note that you can actually change all of this if you want. Now we have operating costs, which is, we have direct costs and fixed costs. You can still change this if you want, but it's always good to leave it the way it is. We have raw materials, direct labor, and all the like. Factory overhead is consumption, like water bill and light bill, energy. Inbound transport is the cost of transporting certain things that are within, maybe raw materials to come and all the like. And then we have fixed costs, which also has transport inside. We know that there are some certain things that each time you must pay transportation for it. Maybe each time you command 50 bags of something, you always pay this amount each time from the north to where you are, or from Douala to where you are, you always pay this amount. When you calculate all of those things, that you always pay one particular transport cost, you realize that you put it here, right? Revenue. All right, this is what I was explaining before. Now the revenue, like some people do in their, I think I'll get the video here, then we'll continue again. Let me say this will be part 3.